is the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery is going to join us to get up to speed on the action from today's session. I'm going to start with the major averages here and the gains that we're seeing after this morning's better than estimated jobs report. Really, even though we got some negative news and negative reaction in two large cap tech names, it did not slow things down today. Also, incremental drip of news that seems to be pointing to some level of potential progress on tariffs or tariff talks with China, maybe. But we're seeing the optimism being felt in the market. The Dow today up 564 points, about 1.4%. The S&P 500 up 1.5%. And the NASDAQ Composite up 1.5% as well, even despite declines in shares of Apple in particular. And Jared, I am certain that you are watching the streaks that we have been seeing in the market.
9 days. We haven't seen that in potentially decades. For the Dow, though, not since, I think, 2023. They had that 13-day run that I'd forgotten about. I'll get to that later in the show. I just want to show you what's been happening with the VIX, which has been coming down nicely. This is a 1-month low, and I'll put a year-to-date chart there. You can see, boom, lowest price or lowest index level in a month. And also taking a look at the ICE of A move index. It's like the VIX for the bond market. That has also come down nicely within the territory that we saw in March with the hiccups in there. And looking at the 10-year T-note yield, speaking of bond markets, we saw a nice jump today. I don't know if you want to characterize it as nice, depends on which direction you want it to go, but it did jump up 9 basis points. And here's the intraday look coming off of that report earlier in the morning. So interesting price action this week, but it has been another bullish week for stocks. And you can just see that right here. All 11 sectors in the green, led by financials, industrials, materials, tech, communication, discovery, consumer discretionary, and then energy. All, what is that, 7 of those outperforming there? And then we can also tally the weeklies. And there we have industrials, tech, and financials taking the lead. Industrials up 4.3%. Nice to see those gains there. And then look at the week in NASDAQ. The NASDAQ 100 here, Microsoft really leading the way as kind of the favorite here in this recovery. Microsoft was up 11% this week alone. Just a quick year-to-date chart. I'll punch that up here. And you can see it is now in the green, approaching those highs that we saw in January. Apple, the saying used to be, as goes Apple, so goes the market. Not this week. The market's up, Apple is down, so a bit of a divergence there. We'll give Apple a few more weeks to find its footing after earnings. Meta's another standout here, up 9% this week. And I'll close on some of the leaders that we saw. Transports. We don't talk about the transports a lot. IYT is a transport ETF. Uber leading the way there. Yes, Uber is part of the Dow Transports. And then China. Didn't talk a lot about China this week, but that's actually leading over a lot of the domestic sectors. Software matching China there, 4.9%. Momentum did well. ITA, transportation, did well. KRE, that's regional banks. So a lot there to look at. Even biotech, look at that second line. Biotech was kind of out for a while along with home builders. So a lot of stuff that's been beaten down has nicely come back up. And I think we'll just leave it there.
Thank you, Jared. We are joined now by Joanne Bianco, Senior Investment Strategist at BondBlocks. BondBlock is a specialized provider of bond ETFs and has more than $4.5 billion in assets under management. Joanne, good to see you. Let's start with that big economic news, Joanne, today. That was that April jobs report. It's a good report. Investors seem to look at it and breathe a sigh of relief, but I'm curious what you made of it, Joanne.
Yeah, we think the same. It's definitely given the Fed more breathing room in terms of interest rate cuts in the near future.
And so what does all of this mean for the Treasury market, which is your bread and butter here, Joanne? Because we have seen, I guess, rates not always behave in ways that you would expect this year.
Mm-hmm. Yeah. Especially long duration rates have kind of had more volatility, but, the shorter to intermediate part of the curve in treasuries and other asset classes in fixed income have been kind of, a bright spot in an otherwise volatile financial market backdrop.
And so, Joanne, for fixed income investors who are listening right now, what is your advice?
Well, we think that, fixed income should be a bigger part of investor portfolios during these times of heightened uncertainty and market volatility. And, but rather than just, so many people are just focused on the uncertainty, we like to focus on what we know and what we think investors can do. Just starting with a lot of fixed income exposures can provide a safe haven in this volatile market environment, and the income that they generate offsets a lot of the volatility that we're seeing. And then, finally, that corporations are, they started from a really strong place fundamentally, and they continue to be there. They're focused on defending their balance sheets and maintaining their strength in the face of this uncertainty. So we just think that all of these factors together, being that fixed income is a great place for investors to be.
Have we seen investors pivoting or flowing to any extent from equities into corporate bonds in particular?
Yes, there has been some activity there for sure, because we've definitely seen flows there ourselves in terms of some of the interest that we're seeing in our ETFs that are in corporates, especially like our BBB corporate ETFs and our private credit ETF.
What about private credit, Joanne? Just elaborate a little bit more on what you're seeing there.
The thing that we see there, so we're involved in the middle market in terms of private credit with our ETF, and it just continues to offer compelling yield and lower return volatility, lower volatility in general in the current market environment. So you're getting, close to an 8%, in excess of an 8% yield with low volatility in the current environment, which investors like.
Joanne, you were saying earlier that you sort of have to deal with what you do know in this environment. What do you think, where is there certainty? What is there certainty around in terms of the macro environment?
I think the main certainty is the fact that, we're even seeing today that, our economy is resilient. It's starting from a very resilient place. The labor market is still strong. And so, it's not to say that we know exactly what's going to happen from here, but, we starting from this stronger place, assuming that there are some resolutions to the trade policy, means that, you should be invested in risk assets like investment grade and high yield corporates.
Final question, Joanne. Fed meeting next week. What do you expect to hear and see from the Fed?
Just the same thing about how they have time to see how the economic data develops and the impact of trade policy on the labor market, while just remaining on alert with regard to what tariffs could do to push up inflation. So, we'll just continue to see them want to take a measured approach, which seems to be the best course of action.
Joanne, thanks so much. Appreciate it.
You're welcome. Thank you.
During a cabinet meeting at the White House this week, President Donald Trump acknowledged that his tariffs could result in fewer and costlier products in the United States, and that could have a direct impact on the children of America.
Right now, and I told you before, they're having tremendous difficulty because their factories are not doing business. They made $1 trillion with Biden, $1 trillion, even $1.1 trillion with Biden selling us stuff. Much of it we don't need. Somebody said, oh, the shelves are going to be open. Well, maybe the children will have $2 instead of $30,
And that's exactly where Rick Newman is going to kick us off in this weekend's rendition of Trumponomics. Certainly that comment got a lot of attention this week when the president said that, Rick.
And the question wasn't even, what do you think American consumers should do as prices of imported products go up and we start to see shortages? The question was just, have you talked to President Xi Jinping of China about the trade war? And Trump meandered into this question or into saying, well, maybe we just need to, basically just saying we need to buy less stuff. And kids have too many toys anyway, so we're going to buy less stuff, but it's going to be American made. It's going to cost a little bit more. And I guess everybody's going to be happy. What that tells me is a couple of things. First of all, the message has gotten through to Trump that we are going to have some product shortages. So that means his economic advisors are telling him, look, we've got basically there are no Chinese imports coming into the United States right now. I mean, those ships are either idled at sea or they're not even leaving China. So when inventories run out here in the United States, we're just going to have a lot fewer, a lower selection of shoes, toys, electronics, appliances, things like this. So Trump's economic advisors are telling him that. And number two, he's testing out ways to try to explain his tariff policy to Americans as they start to notice the pain that these tariffs are going to bring. I don't think that's a great line. Telling Americans to buy less is not the kind of message they like to hear. As we know, the whole U.S. economy runs on consumer spending. So maybe we will get a few different lines from Trump in the next couple of weeks as he tries a different approach.
Thanks, Rick.
Bye, guys.
Earnings season, of course, is in full swing with big tech chiming in on the state of business amid macro uncertainty. The tech heavyweights, as well as consumer names, highlighting the cost dynamics as a result of President Trump's tariffs. The uncertainty of new duties driving households to get ahead of the curve on goods purchases, sending consumer spending higher in March. Meanwhile, companies have been looking for ways to minimize tariff impacts and navigate ongoing uncertainty. Here's what executives had to say on those latest pressures.
Look, I think consumers obviously are feeling some pressure. There's no doubt that you're seeing consumer sentiment go down over the last couple months. But I do think they're still being very choiceful in where they want to spend their money.
To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact. We also have not seen the average selling price of retail items appreciably go up yet. Some of this reflects some forward buying we did in our first-party selling, and some of that reflects some advanced inbounding our third-party sellers have done.
We definitely saw some deceleration in certain parts of the economy, but also strong spending growth in other parts of the economy. There's some category spending switches, a little less spending in travel, a little more spending in some segments of retail.
We believe that the best way forward is to not charge tariffs on pharmaceuticals, but create an environment that attracts investment through an attractive corporate tax rate.
The higher costs we expect to incur for infrastructure hardware this year really comes from, suppliers who source from countries around the world. And there's just a lot of uncertainty around this given the ongoing trade discussions. And so that is both reflected in the wider range that we are giving. And we're also working on, on our end on mitigations by optimizing our supply chain.
Assuming the current global tariff rates, policies, and applications do not change for the balance of the quarter and no new tariffs are added, we estimate the impact to add $900 million to our costs. This estimate should not be used to make projections for future quarters, as there are certain unique factors that benefit the June quarter.
So I think it's more a continuation of certain consumer segments under pressure because of inflation coming out of last year, that we need to deliver affordability options. Given the current dynamics, Q2 and Q3 could be a little choppy, but we know what we need to do as it relates to the US within the global portfolio.
We have been listening for all of the tariff mentions on earnings calls this season, so let's recap some of the latest that we are hearing. Big Oil reported earnings this morning, and while we saw solid first quarter results, the energy sector is still facing headwinds from macroeconomic uncertainty. The Exxon CEO talking about tariffs on the earnings call, saying, quote, coupled with the threats of increased OPEC supply, we are seeing significant downward pressure on prices and margins. Then there's Eaton, the power management company, also posting first quarter earnings today, and it did post solid results on the top and bottom line, but it hasn't been immune to the tariff impact. Eaton COO opting not to address the specific amount of the tariff impact on the earnings call, saying, quote, we decided not to disclose that number because we'll be wrong in a week's time. And then there's Apollo Global Management. That, of course, is the parent company of Yahoo. The company, with approximately $785 billion of assets under management, reported first quarter earnings this morning as well. And on the call, President Jim Zelter highlighting the broader impact of tariffs on the market, saying, while the tariffs should not have come as a surprise, the scope and approach clearly rattled markets. We'll be on Tariff Watch again next week.
Well, Apple reporting second quarter earnings last night. Investors still digesting comments from CEO Tim Cook on multiple topics, including Apple Intelligence.
During the March quarter, we saw that in markets where we had rolled out Apple Intelligence, that the year-over-year performance on the iPhone 16 family was stronger than those where Apple Intelligence was not available.
For more, we're bringing in now Lance Ulanoff, editor-at-large at Tech Radar. Lance, always good to see you. So let's start there with Apple Intelligence, Lance. You know, if you're an Apple investor, you're an Apple fan, the next date you have on your calendar is WWDC, the big software show that happens in June. Would you expect, Lance, to get more news, more updates perhaps then about Apple Intelligence?
I would hope to, but I've had so many conversations about what is WWDC 2025 going to be like. This is such a strange one because it's a year ago that they introduced the whole concept of Apple Intelligence and said that really by this time we would have had all of it. We do not have all of it. In particular, we don't have the grand new Siri. So Apple may do something quite simple and just act as if nothing has happened and really focus on showing us for the first time and letting us touch the new Siri in action. So say, here it is, it's working, it's coming out, by the time you walk out the door, it's going to be available to iPhone 16s and maybe iPhone 15s. Something like that has to happen. They have to explain what's going on.
And if they don't, Lance?
I don't know. They can't act, they can't act like nothing is happening because we are in the world of AI now, right? This is a competitive space. Apple came late to the game, and what it really doesn't have is a conversational AI to match everything that's out there, including Google Gemini, and we're about to hit Google I/O, and they're going to show off a lot more stuff about AI. So Apple can't run away from it, can't act like it's not happening. They definitely, Tim Cook acknowledged it's taking longer than they thought, but they're making progress, and they just want it to be perfect. They want it to be just the way Apple wants it to be. But that's not enough. They have to show us something. They have to deliver something, or people are going to get really frustrated.
Lance, let me ask you, so if you're an Apple investor and okay, well, there's going to be this tariff uncertainty, and you heard the executives on the earnings call last night, they said, listen, we can't forecast even what the tariff impact will be past the June quarter because things are just that fluid. At the same time, in the fall, Lance, we'd expect to see iPhone 17. Is that the next potential catalyst then? Is that the next potential tailwind I'm looking for if I'm an investor in this company?
Well, look, I'm not an investor or financial expert, but what I'll say is that, I listen to these earnings calls and I read these earnings reports and I go, oh my God, Apple just earned another $95 billion. They're doing okay. The services business is exploding. They're doing all right. But, there is pressure for Apple to innovate, and there's pressure for Apple to show off something big. And of course, people will look to the future. They will look to September, and that is when we're going to see iPhone 17, and maybe we'll see something new and special. And by new and special, I mean maybe the iPhone Air, that ultra-thin iPhone that everyone keeps talking about. I don't think we're going to see a folding iPhone, although everyone wants to see that. But that would be exciting, and I think, again, the iPhone still drives the majority of their revenue, so whatever they do in September is going to be very, very important.
And Lance, let me ask you this. I mean, we've become pretty complacent about this amazing piece of technology that we carry with us everywhere. It's become a utility. We're sort of an immune, like it's pretty cool, but there's not the sort of gee whizness that there was at one point about the Apple products. Does something like that Air get that back? Is it the Apple Intelligence Siri? I mean, what would you see as I mean, you're really steeped in this stuff, so maybe you still have that wonder when these products come out, but for what do you think?
I mean, I do. I don't have wonder for things that are iterations, right? And so much of what we see in the smartphone market are just iterations, right? And we are very excited about the folding phones we've seen from companies like Google and Samsung and are waiting on Apple on that. But again, that's not Apple being first. I don't think they're going to change the game. We saw the Vision Pro, and that was probably a moment of excitement until we heard the price and then realized, oh, this will never be for everyone. So I really can think back very clearly to when we first saw the iPhone and how desperate I was to touch and hold it and use it. And then I used it and I actually had a real moment of astonishment. So that doesn't happen very often, and I'm not anticipating that happening with Apple unless it does something extraordinary that we're not expecting, that one more thing.
Lance, what about the other headline we got this week, this court fight between Apple and Epic? I'm interested to get your thoughts there. There were some analysts, Lance, who were saying, listen, it's a negative headline, but I know they were telling their clients they thought at the end of the day it would be financially manageable because they just thought most developers, at the end of the day, in their opinion, they're going to stick with Apple, the App Store, the Apple payment system because they know it, they're comfortable with it, ease of use. But what do you think?
Yeah, there's been some conversation online that I've seen, which I kind of agree with. It's that there are some squeaky wheels that have been arguing for this, and of course the big companies that demand to have the freedom to do what they want. But the majority of consumers are quite happy to work with Apple the Apple way. They're very happy to open up their iPhone, go to the App Store, get the apps, and not worry about it, and go about their business. So the fact that Apple's being forced to offer these other avenues is not going to change the game, and it's not going to change the picture for Apple. I know that they got their wrist slapped here. I mean, I read that court injunction, that court order from the judge. It was rough. That person was angry and accused Apple of basically lying. But Apple never really lied. It just did it out in the open. Here's what we're doing. You may not like it, but it serves our purposes. Off you go. But I don't think this is kind of a measurable impact on consumers or even Apple's bottom line.
Final question on all things Apple, Lance. I want your take on how you see the company performing in China. They did report falling sales in China, though there was clear sequential improvement. I'm just curious what you made of what you saw in the business there and what you see ahead.
I mean, China's a tough business because there is competition there that is growing very fast. I think China, it's always confusing for me, like how much help does the Chinese-based corporations, technology companies get from China to support and help expand their businesses? Apple, any American company going in there, whether or not they're building the products there, is going to have headwinds, right? They're going to be, it's going to be, even though they've done well, and I know that they've done well in, different areas of China that they've seen some real growth, but China would like to see its homegrown businesses do even better. So it's always going to be Apple having to do the extra hard work. They've really grown the business quite a bit there. I don't know if it'll grow as fast anymore, especially with all the geopolitical stuff going on, where things could change dramatically. And I think the thing that we're learning about Apple in this whole tariff situation is that it's very good at preparing. It's very good at managing these situations because it knows how to handle supply chains.
Lance, always great to see you and to have you on the show. Have a great weekend.
It's a pleasure. Thank you.
Time now for What to Watch. We're going to start on the tariff front. President Trump's tariff on auto parts set to take effect on Saturday. This is coming after Trump signed an executive order earlier this week softening some of the automotive tariffs.
Switching over to earnings, Berkshire Hathaway reporting numbers over the weekend. Investors will be keeping a close eye on where Warren Buffett is investing and what the company will look like potentially without him at the helm. Some other big names from across all sectors reporting next week, including Palantir, Ford, AMD, and Disney. Disney having a strong start to fiscal 2025, but analysts anticipate headwinds for theme parks, the company's biggest profit driver, due to potential consumer pullback.
And taking a look at the Fed, the two-day FOMC meeting kicking off on Tuesday. The Fed's interest rate decision on Wednesday. Wall Street largely expecting the Fed to hold interest rates steady in May, but investors will be listening closely for any commentary on the tariff impact to inflation. Yahoo Finance's Fed Day coverage on Wednesday will begin at 2 p.m. Eastern.
That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.